to our YouTube channel, Vanijja. In this video, we move beyond the basics and dissect the complex mechanics of letters of credit, specifically deferred payment and acceptance. Did you know that in international trade, the difference between deferred and acceptance in an LC doesn't just change when you get paid? It fundamentally changes the financial instrument you hold. The challenge for trade professionals is understanding the two primary UCP 600 mechanisms for structuring trade credit: deferred payment and acceptance. This guide equips you to dissect the procedural, legal, and financial differences, allowing you to select the optimal credit structure and confidently negotiate financing. Here is our roadmap. We'll cover legal framework, deferred payment, acceptance credits, and commercial implications. Let's start with the legal framework of honor and tenor under UCP 600. Every letter of credit represents the bank's definite undertaking, a firm, unconditional promise to pay the seller upon presentation of compliant documents. The core concept is honor, which means fulfilling that promise. This includes immediate honor for site payment and delayed honor, or usance, for future payments. Now, let's examine the deferred payment letter of credit, the most streamlined method for trade credit. A deferred payment LC establishes a future payment date without requiring the creation of a separate negotiable instrument. When the seller presents compliant documents, the bank issues a formal, binding deferred payment undertaking. The bank takes the documents and records an irrevocable, non-recourse obligation to pay on the maturity date. Crucially, the seller does not present a bill of exchange or a draft. The bank's liability is established solely by accepting the commercial documents. Next, we have acceptance credits, the traditional method for structuring usance credit. The acceptance letter of credit achieves delayed payment through the formal creation and acceptance of a time draft or bill of exchange. The seller is legally required to draw a specific time draft on the specified drawee bank, requiring payment on a future, determinable date. The bank honors the presentation by formally accepting the time draft. This means the bank signs or stamps the face of the draft. This signature legally transforms the draft into a banker's acceptance, or BA. This BA is a highly sought-after, unconditional liability of the accepting bank. The choice between these two mechanisms heavily influences your ability to manage cash flow through pre-maturity financing, also known as discounting. Both the deferred payment undertaking and the banker's acceptance are highly liquid and can be discounted or purchased for immediate cash. Discounting a BA is an established practice, since it is a negotiable instrument. Purchasing a deferred payment obligation is done under a structured financing arrangement. In conclusion, both methods provide the seller with an identical, non-recourse bank guarantee of future payment. The primary distinction is procedural. Deferred payment is simpler, based only on document acceptance. Acceptance is formal, creating the tradable banker's acceptance instrument. Your choice often boils down to operational preference. Do you prefer the simplicity of the deferred payment LC or the financial flexibility and secondary market characteristics of the BA? Do you have any questions about deferred payment or acceptance LCs? Leave your questions in the comments section below, and I'll do my best to answer them. If you found this explanation helpful, please like the video and subscribe for more in-depth trade finance content. Thank you for watching, and we'll see you in the next video.
Stay ahead in the world of global commerce. Subscribe to Vanijja for expert analysis, and don't forget to like this video.